Is she speaking?
So,
No, but we cannot hear her.
good afternoon, ladies and gentlemen, and welcome to the conference titled Cohesion 2.0, the crisis and the economic and financial models of convergence, the Portuguese and Czech cases of European integration. We are coming to you live from the European House in Prague, where the conference center has been rebuilt to a provisional studio to serve online events. I am Pavlína Žáková. I work as economic advisor at the representation of the European Commission in Prague, and it is my greatest pleasure to guide you through the first part of today's conference.
It was like that, I don't know when I should start.
We will discuss today the convergence story of the Portuguese and the Czech economies, and how these two countries face the economic and financial challenges stemming from the current COVID crisis. The conference is organized by the Embassy of Portugal in the Czech Republic in cooperation with the Institute for Politics and Society, the European Investment Bank, and the representation of the European Commission in the Czech Republic. The conference is the first event. Are there any technical problems? Back to the production.
We are listening to you very well.
Okay, thank you. Thank you. So the conference is organized by the Embassy of Portugal in the Czech Republic, as I mentioned, in cooperation with the Institute for Politics and Society, the European Investment Bank, and the representation of the European Commission in the Czech Republic. The conference is the first event in a series of conferences to be organized by the Portuguese Embassy in Prague during the first half of this year, when Portugal holds the presidency of the Council of the European Union. Let me immediately pass the floor to His Excellency, Mr. Luís de Almeida Sampaio, the ambassador of Portugal in the Czech Republic, who is the father of the idea of this cycle of conferences and who will, in his welcome remarks, explain the objective and the key topics of today's event. Dear Ambassador, the floor is yours.
Very good day to all, and my warm welcome to this cycle of conferences organized, as Pavlína just said, by the Portuguese Embassy in Prague and its partner organizations in the context of the Portuguese presidency of the Council of the European Union. I am pleased to be your host today and delighted to welcome our guest speakers, whom I thank in advance for their participation. They are the guarantee of a very successful conference. And our knowledgeable and experienced moderator, Pavlína Žáková, will introduce the members of the first two panels of the day in a moment. Let me also profusely thank our partner organizations, the European Commission, through its representation in the Czech Republic, the prestigious Institute for Politics and Society, and the European Investment Bank. Without them, this conference would not have been possible. The presidency of the Council of the European Union takes place at a particularly challenging time, a time when the COVID-19 pandemic and its socio-economic consequences represent an unprecedented challenge for the Union and its member states. Therefore, to face that challenge, the Portuguese presidency will seek to strengthen Europe's resilience and our citizens' trust in the European social model by promoting a union based on the values of solidarity, convergence, and cohesion, and a union capable of acting in a coordinated manner for all of us to recover together from the crisis. With this in mind, we will work on three main priorities: promoting a European recovery leveraged by the climate and digital transitions, delivering on the social pillar of the European Union as a key element to ensure a fair and inclusive playing field, and strengthening the strategic autonomy of Europe that is open to the world. Portugal will do its most to start a new at the helm of the Council of the European Union, focusing on the entry in force of the new multi-annual financial framework and on the implementation of the innovative and ambitious toolbox of financial instruments agreed at last July European Council. But we will always underline the role of the European Pillar of Social Rights in responding to the social dimension of the crisis. So, all in all, it is against this ambitious background that the Portuguese presidency of the Council of the European Union in the Czech Republic takes place, and it is in that vein that we promote this cycle of conferences and an economic roadshow under the overarching title, Europe After the Pandemic, How to Overcome the Crisis, Deepen the European Project, Rebuild the Transatlantic Link, and Restore Cohesion. What are our specific objectives? They are very simple to highlight: to enhance the opportunities that the Portuguese presidency of the European Union represents, to foster the visibility of Portugal in the Czech Republic, to improve and to deepen our bilateral relationship with the Czech Republic, and to contribute to the wider debate on the crisis triggered by the COVID-19 pandemic. Thus, our conference of today, the very first of our cycle of 7, its title, Cohesion 2.0, the crisis and the economic and financial models of convergence, the Portuguese and the Czech cases of European integration. The crisis triggered by the COVID-19 pandemic spread from health to economics and finance at warp speed and in multifaceted ways. It is thus a daunting task to attempt to adjust the unprecedented public health requirements and simultaneously to try to mitigate the economic impact of the crisis. So, without any further ado, it is my pleasure to hand the floor back to Pavlina Jakova for her to keep the ball rolling. Enjoy.
Thank you very much, dear Ambassador. Thank you also for your welcoming remarks. We truly appreciate your initiative to organize this economic roadshow, as you said, which will, on one hand, stimulate a debate on European integration in the Czech Republic. But on the other hand, I hope that these conferences will also give to the Czech audience a sense of the Portuguese economy, which may seem so far away in terms of geographical distance, but has a lot in common with the Czech economy in terms of its convergence history and current challenges. So now, before we open the first panel, we will have the pleasure to follow the video message by Mrs. Elisa Ferreira, the European Commissioner for Cohesion and Reforms. We can't have a better suited keynote speaker for this conference. Commissioner Ferreira is a member of the European Commission appointed by Portugal. She is in charge of cohesion, the very topic of this conference. And previously, she served as the vice governor of the Portuguese Central Bank. Commissioner Ferreira was not able to participate at today's conference live in person, but she was so kind to greet us all in a video message. So I will ask my colleagues to put it on.
Your Excellency, distinguished guests, thank you for your kind invitation to speak today. I am unable to attend physically, but unfortunately, we have now many options and I can be instructed. And I wish to add some reflections to the discussion. We hear the word right. This word comes to us, as you know, from the weeks, commitment and judgment, the moment of truth. When we see what is useful and what is not. It means a ship in a storm and the sailors deciding what must be kept to save the ship, how to steer the course and adjust the winds. So this is my question. What do we keep? What have got we to throw away? What must be changed? Because what we keep and what we change will define our new model, our Cohesion 2.0. First, what must we keep? To successfully navigate today's storm, we must keep the values of cohesion and solidarity. In Europe, we do not leave countries or regions or people behind. We do not throw our fellow sailors overboard. Lessons learned from the past crises, recent and not so recent, form this key value. Cohesion policy has a proven track record of investment in convergence. The cohesion and convergence stories run very differently, of course, in Czechia and in Portugal. And this is for many reasons. The different geographic location, the phase in which we are, and the depth of economic integration in the two countries, the structure of the economic and industrial landscape, the profile of the workforce. There are too many differences. And also the most recent history matters too. And here I mean the 2008 global financial crisis and the dent it has made in the economic fabric of a lot of countries. However, the constant element, the common feature between the two countries is constant permanent support and solidarity from the European Union. Both countries have made a huge leap after their accession to the European Union, benefiting from this convergence machine that represents the European Union membership. But history also showed us that cohesion is not linear, does not travel only one way, and should not be taken for granted. For Portugal, for instance, over 2014-2020 program period, also due to the macroeconomic constraints in the aftermath of the crisis, European Union funding under cohesion policy was equivalent to nearly 80% of total government investment. And this is even before the COVID crisis. The equivalent figure for Czechia was 40% of total government investment. This investment has borne fruit over the years. For example, in the year 2000, Czech GDP per head adjusted for purchasing power was around 73% of the European Union average. In 2018, so 18 years later, it had risen to more than 91%. It's a lot. In the crisis, cohesion policy support is needed more than ever. Many industries are suffering. I think of tourism in Portugal, or I also think of the manufacturing supply chains in Czechia. So we must keep the solidarity of cohesion policy, and we must keep the investment. Investment during the crisis and investment in the long term. But what must we change? First, investment must be accompanied by the right reforms. I emphasize right, adequate reforms. What are these reforms, these right reforms? Reforms which build the capacity and improve key vectors conducive to growth and a vibrant economic activity. Reforms, for instance, of public administration, the business environment, the social and education infrastructure. Experiences teaches all of us that investment alone is not enough. Structural problems require structural solutions. The new Recovery and Resilience Facility is a once-in-a-generation opportunity. It can finance substantial investment across the economy, but these investments must be coherent and have a long-term impact. That is, they must support reforms. They must support the structural change that will make our economies more competitive, more resilient in the future, more capable of producing wealth for our citizens in a sustainable way. In order to ensure that, to assist that effort, I draw your attention to the possibilities offered by the technical support instrument. This is at the service of member states to support the design and also the conditions for implementation of reforms. Second, investment must focus on the future. The green and technological transformations rightly prioritized by the Commission and by the current Portuguese presidency. We cannot and should not invest in past technologies. A good example of cohesion support for the future is the National Supercomputing Center in Moravia, Silesia. 5 research institutes provide technology and expertise. The center brings together scientists and industry and is a resource for systems which enhance industrial design, advance medical technology, predict natural hazards, and much more. Third, this must be done in partnership with the different levels of government, business, social stakeholders, civil society. National strategies cannot be the work of a legislative term or a single government. They need to be owned, embraced by the wider political and social spectrum. They also need to consider the territory as a whole. No country can prosper amidst internal imbalances. A polycentric model with different middle-sized cities driving growth of different regions is obviously much preferable to the entire country depending on a single pole of growth. This doesn't work in long term. In conclusion, Cohesion Policy 2.0 will be an upgrade. First, it will be a policy accompanied by the right reforms from public administration to social and educational infrastructure. We have a unique window of opportunity here. Second, it will be a policy looking forward, facing the future, investing in a green, digital, and technological revolution. Third, this will need to be done in a participative manner and in a territorially balanced way. In all these changes, we must stick to our core values, our core business, and to our proven track record of success. A policy motivated by solidarity, delivering solid investments in partnership with local people. These values have seen us through many previous crises, and they will see us through this one too, and also the years of transitions and changes to come. We will become more resilient. Both Czechia and Portugal have valuable lessons to share on how to navigate through crises and how to rebuild in their aftermath. Let's share those lessons and debate the way forward. And then let's deliver it. I wish you a fruitful discussion. Please keep safe. And thank you once again for inviting me to this meeting. Thank you.
So this was the perspective of the European Commissioner Elisa Ferreira. The main takeaways I have noted are convergence machine, the story of solidarity, upgrade of cohesion policy towards green and digital transition. But now, without much further ado, let me introduce the first panel of today's conference. We have highly distinguished guests with us today. So let me welcome Mr. Jiří Rusnok, the Governor of the Czech National Bank, Mr. Mario Centeno, the Governor of the Bank of Portugal, Mr. Ricardo Mourinho Felix, the Vice President and member of the Management Committee of the European Investment Bank, Mrs. Lenka Dupáková, Deputy Minister of Finance for International Relations and Financial Regulation, and Mr. José Carlos de Azevedo Pereira, Director General of the Planning, Strategy, Evaluation and International Relations of the Ministry of Finance of Portugal. Let me remind you all that this conference is interactive to some extent at least. So let me encourage everybody who is watching online to participate. You can ask questions to our speakers via Facebook. And if you want to address your question to a particular speaker, please do specify it. And now to the panel. As outlined by His Excellency Mr. Sampaio and by Commissioner Ferreira, there are a number of similarities and differences between the Czech and Portuguese economies. A similar population size, a similar experience with fast convergence after EU accession, an important role of EU funds in supporting the catching up process. On the other hand, these two countries have a very different geographical location on the map of Europe, a different structure of the economy, a different currency. Both countries will want to restore the convergence process, as Commissioner Ferreira put it, to benefit from the convergence machine when the current crisis is over. So I would like to invite you to share your thoughts on the convergence process in both countries, as well as your own perspective on how to relaunch recovery, or maybe even how to benefit from the current forced lockdown to rethink the country's model of economic growth. We would like to hear from you also how the experience of these two countries fits in the story of the EU as a convergence machine, as we have heard, and looking forward, what impact the current crisis may have on cohesion and convergence in Europe. The first speaker of the panel is Mr. Jiří Rusnok, the governor of the Czech National Bank. His CV is very impressive. He served as Prime Minister of the Czech Republic and previously also as the Minister of Finance and Minister of Industry and Trade. Dear Governor, please, you can start with your introductory remarks.
Thank you very much. Good afternoon to everybody. Ambassador, Governor, dear Mario, and all distinguished guests and participants. It's my great pleasure to be at least on this video conference with you and to have the opportunity to start the first panel. In my contribution, I will basically focus on very recent economic development in the Czech Republic, and of course I will present the view of the Czech National Bank. So maybe not so much about the history of convergence, but I'm sure that other speakers and highly probably in discussion, a lot of people will contribute to this specifically. So let me to start with my presentation. First of all, I will say a few words how we see the current crisis, how we characterize the crisis, which is, so please the next slide, if I can ask. First of all, it's an exogenous original crisis, basically the pandemic shock for which no one is to blame. Of course, it's a health and economic jointly crisis of unprecedented size in living, I would say, peacetime memory. What is key? It's a trade-off in many phases of this crisis we already have experienced and we probably will experience even in the near future. It's a crucial key trade-off for the policymakers between the flattening of infection curve, so to minimize the deaths and people in hospitals, and inevitably steepens macroeconomic recession curve. So what governments and central banks try to is, first of all, moderate or diminish, if possible, macroeconomic costs of this crisis. There is definitely very typical phenomena for this, and specific phenomena for this crisis is asymmetric impacts on different industries, branches, activities, and areas. So we have some areas of economic activities who we can count as the losers of this current crisis, like travel, restaurants, transport, partially at least, of course, entertainment, sports, trade fairs. So basically all activities related to or dependent on the movement of people and contacts of people. On the other hand, we have also the winners, of course, so information technology, e-commerce, medical equipment, pharmaceuticals, so health, mostly health related, and it's a communication related activities. The next slide, please. Of course, the crisis is changing the structure of demand and supply. Shocks over course of crisis. During the shutdowns, there is a negative demand, at least partially in some areas, and at the same time also negative supply shocks. Between waves of the pandemics or shutdowns rather, there are mostly predominant the negative demand shocks. So the consequences, we are living the time of unprecedented uncertainties. What we probably can expect and what happened, that the precautionary savings are growing. At the same time, of course, the investments are declining. We have observed these structural shifts across the sectors regards outputs and employment. Activities are maintained mainly online. In some cases, the supply chains, global supply chains even, are shortening. We have observed some substitution of imports and some signs of deglobalization. So let's go further. The next slide, please. The Czech Republic specifically, we've been quite lucky since that before the COVID crisis came, the stance of the Czech economy was relatively very good from perspective of the balance and growth. So we have had low public debt, one of the lowest in the EU, around 30% to GDP. In my area or of central bank competencies, we have managed to almost, I would say, normalize the monetary policy stance. So there was certain space for maneuver to ease the monetary conditions after the crisis came. We have, as it was also already mentioned, our own currency, which is in such a situation, which serves is this situation like a buffer, like an anti-shock absorber, through spontaneous depreciation, which helps to ease monetary conditions basically automatically. We have had and we still have the sound and resilient banking sector, which is one of the very crucial preconditions to manage this complicated situation in economy. And despite certain slowing, which started already in the beginning of 2019, the Czech economy was still buoyant, I would say. We have observed some signs of overheating in area like the housing market. So the prices of housing has grown recent years before the crisis, even continuing during the crisis quite rapidly. We have the shortage in supply of labor force, which of course also contributed to the rapid wage growth. And inflation was slightly elevated, amongst others also because these quite strong growth of private consumption, including the growth of wages in the period before the crisis. Next slide, please. So in 2020, we have observed, of course, the significant drop down of the economic output. GDP plummeted quite rapidly in the second quarter of the year. So just after the start of the pandemic, it rebounded quite significantly in quarter three, in third quarter, and we will see the quarter four results only later on, but we suppose it will be quite positive. Nevertheless, still we expect, or our assumption is in our November forecast that the GDP will decline around 7% in 2020. We will have the new forecast quite early in the next month, in the beginning of the next month. I can speculate that finally this number regarding the economic output 2020 will be a bit better, a bit milder decrease than we have expected earlier. Of course, previously overheated labor market started cooling, nevertheless, relatively or quite slowly. Average wage growth remained relatively high. We can expect that the whole year number will be plus around 4%, even maybe up to 5%. Unemployment increased, but marginally, and still the Czech Republic belongs to the countries with the lowest rate of unemployment, and we can observe quite frequently the shortage of labor force in many areas. First of all, manufacturing industry, there are still a lot of complaints for shortage of labor force available on the market. Corona weakened, as I already mentioned, the start of the pandemic crisis gradually strengthened with certain volatility, which was and is still driven mostly by regional financial market sentiment. Inflation was slowed from rather elevated rates in the beginning of the last year, which was significantly above our target 2% and tolerance band plus minus 1%. Nevertheless, in the end of the year, the inflation has dropped significantly, quite close to the area of our inflation target of 2%. In this year, we suppose the inflation will fluctuate quite closely around the target of 2%. Of course, policy, so first of all, fiscal and monetary policy started to release significantly and became highly accommodative almost overnight. Next slide, please. I can present you on these few graphs which will follow regarding the main policy indicators. I mean, economic policy, of course, government debt increased rapidly. Before the crisis, Czech Republic has had more or less the balance, or even some years slight surpluses in public finance. The last year there is a significant deficit, around 6.7% of GDP, which is of course mainly due to the quite strong stimulus to moderate and make up the impact of the crisis in area of small, middle-sized and small companies, and generally towards the companies and households, and of course also the losses on the revenue side in taxes. As the next slide, please. So the total government debt has increased significantly, as I already mentioned, from the level of around 30% to GDP. Now we are around 37, maybe 38% to GDP, but still remains relatively, in European context, very, very low. The next slide, please. Regarding monetary policy and macroprudential policy, because the Czech National Bank serves not only as a monetary authority, but also the macroprudential authority and also the unique supervisor of the financial market. So first of all, in macroprudential, we have decided in very beginning, into April 1st, to reduce the countercyclical buffer first by 75 basis points. Later on, we did the next steps in these regards, and we reduced to 0.5% these rates, which is valid till days. We, of course, in line with the recommendation of ECRB, has called on banks and insurance companies not to pay dividends, preventively increased. We also decided to increase weekly number of liquidity, providing monetary operations. We have supported the new act on the loan moratorium, which were available to the bank customers for 3 or 6 months since I suppose it was spring months till the end of the November of last year. We have also softened strongly, I would say, recommendations for assessing new mortgages in framework of our macroprudential policy. So we have raised the limit for LTV, and in 2 steps we have basically decided to switch off the DSTI and DTI criteriums for the mortgage clients. So the next slide, please. This is about our monetary policy actions. We have had cut the policy rate 3 times in quick succession since half of March to the beginning of May, and we have decreased from 2.25 to 0.25. It means we almost entirely used up the potential of our main policy instrument to ease interest rate component. Currently, we do not see other necessity to continue this way, at least at the moment and near future. So the next slide, please. So the current development, we are now living the second or maybe third wave of pandemic, which is probably peaking or has peaked few days ago. At the moment, the Czech Republic ranks among very worst countries in the terms of the number of cases of the infection. The stringency index abroad is also worsening. So the anti-epidemic measures will be stronger and longer than we predicted recently. Vaccination is currently being rolled out, will be hopefully the game changer, but you know, it will take time, of course, since the shortage of the vaccines. So there are some risks for the current and near future development. New strains of virus that vaccine will be, maybe, nobody knows basically, is sufficiently effective against, the delays in distribution and application of vaccines, and coronavirus fatigue, decrease adherence to lockdown rules, spread of pandemic. So basically people are already exhausted, of course, of this situation, and the discipline could fail in some cases. So government is, of course, in very difficult situation because the pressure to relax anti-epidemic measure is getting to be harder and harder, very probably. As regards the economy, please, the next slide. Now it's already clear that we are heading for a double dip recession. Hopefully the second dip likely to be shallower than the first one. Mainly because the industry, manufacturing industry, is doing relatively very well in this second/third wave of the pandemic, which is a big difference to compare with the spring months. Unemployment will inevitably rise in this year. Situation will be definitely, let's say, more gloomy. Nevertheless, still, Czech Republic will become probably amongst the countries with still a relatively low unemployment rate. There are some structural reasons for that. I would mention the aging of the population, shrinking the labor force capacity, and at the same time still relatively highly job-consuming industry with significant weight in the economy structure. So the difference between manufacturing and services is continuing. There is, of course, nevertheless, certain risk of negative spillover from services to manufacturing. Hopefully, our main assumption in our basic scenario is that summer or close to the summer, we should see start of the recovery, which could be relatively quickly and could bring the Czech economy into the positive shape quite quickly during this year. Next slide, please. I will go to finish. Yes, I already mentioned there is a certain difference between first and second wave of pandemics. First wave in spring, where the epidemiological situation was very moderate comparing to what we experienced later on in autumn, but the economics terms was extreme because there was basically the total lockdown in the society. The second wave from epidemiological situation is much worse. Nevertheless, economic costs are lower, mainly because the still relatively well running manufacturing industry, which use the external demand or even solid external demand. Mainly, of course, the German economy is the most important factor from our perspective. So last slide, please. The summary. What I would maybe underline, the contraction likely to be smaller in the second wave than the first wave, mainly thanks to the industry relatively good condition and significant large weight of industry in the total structure of the Czech economy. Labor market is cooling, but still very slowly. Inflation is heading towards our inflation target. We do not see really the need to ease further the monetary condition in the near future. In the a bit longer future, we rather would expect if the positive assumptions will fulfill to go back subsequently to more normal setup of the monetary policy stance. The Czech economy has had a relatively good starting position before the crisis as regards monetary situation and also the fiscal stance. So Czech final sector remains very resilient. This is the part of the solution of the problem, not definitely the part of the problem. So I would finish here. Thank you for your attention, and I'm of course ready to the question, if any. Thank you very much.
Thank you very much, dear Governor, for this comprehensive overview of the impact of the current crisis on the Czech economy, as well as the measures taken by the Czech National Bank. As we could hear, the Czech economy entered the crisis with a favorable starting position, low public debt, low unemployment, sound and resilient financial sector. And we are also pleased to hear that the upcoming macroeconomic forecast of the central bank will be more optimistic than the previous one. It's always good to hear good news from the central bank. On the other hand, you also stressed several issues to watch, such as the quickly rising public deficits and debt, and the double dip recession. So thank you very much. And let me now turn immediately to Mário Centeno, the governor of the Bank of Portugal, who is joining us from Lisbon, I believe. Mr. Centeno served until June last year as the Minister of Finance of Portugal, and you may recall his name in particular as the chair of the Eurogroup, a function that he held for 2.5 years until July last year. So I would like to invite you, Mr. Governor, to tackle the questions of convergence and how to reshape our economies after the crisis from the Portuguese perspective, of course, but also possibly from your experience as the chair of the Eurogroup. Please, the floor is yours.
Governor, microphone, please switch on.
Yes, we can't hear you. We can't hear you yet.
Not yet?
Yes, now it's fine.
Okay, okay, there's a double barrier here. so, sorry for that. Well, good afternoon from Lisbon, indeed. I'd like to thank Ambassador Luís de Almeida Sampaio for the kind invitation to speak about the crisis and economic and financial models of convergence in such a distinguished panel of speakers. And I'd like also to send a warm hello to Governor Rusnok, who already intervened in this panel. Well, convergence is a long-term process. It requires long-term commitment and strong and flexible institutions. We must ask ourselves if this is the case in Europe today and in each of our countries. And if we think this is not the case, I think we have already a very good recipe for action. I am optimistic. So I think Europe is much better equipped today than in the past regarding its institutions. And we must be sure that the pandemic crisis, which was unique and exogenous, raises challenges and questions for the future of Europe, and we must be ready to act. In Europe, the initial response to the pandemic was quite unprecedented and coordinated. And these are indeed good news for cohesion and convergence. However, the outcome of the pandemic crisis, which will differ across countries, will pose challenges ahead of us. We must understand that one size will not, indeed, it never does, fit all. All decision makers in each and every area and jurisdiction have been swift, innovative, and let me stress this again, coordinated. The crisis emerged as temporary and symmetric, affecting all sectors in a dramatic way. This boosted the reaction in the European Union and the euro area. But the crisis, due to its sanitary nature, evolved quite asymmetrically, with some sectors and countries particularly penalized, as Governor Rusnok already outlined. And this is where the challenges ahead lie. Once again, Europe will move at different paces, but this time not for structural reasons. There is no justification for the old worries about moral hazard and wrong incentives to surface. Well, I believe that European countries will stick together and reinforce the common stance. It is also true that the risks to cohesion and convergence stem from the asymmetric nature of the crisis. This is an outline of my presentation, but first let me go through some facts and how they will play out in the coming months or even years. Unlike in previous crises, the monetary and budgetary policies adopted by member states and in Europe throughout 2020 are complementing each other. The policy response prevented a lengthy and catastrophic crash, which could have led to substantial job losses and widening inequality, risking the cohesion and convergence efforts among member states. Together, these policies amount to more than 1.5 trillion euros of support to the economy, defined over a very short period of time. From an economic and political perspective, this innovative experience of coordinated policies will, in my view, have lasting effects on the decision-making process in Europe. We went all the way with the European Commission issuing common debt. And although some see it as a one-off issuance, temporary, the fact is that this debt will be around for many years to come, decades in reality. It will be traded in financial markets, which so far show the tremendous appetite for EU-issued debt. Policies in Europe will not be the same after this huge success. In this context, we can reflect about the future. This was exactly what finance ministers in the Eurogroup said in April 2020 as their goal. And I'm going to remember you of a piece of the statement issued by them. Subject to guidance from leaders, discussions on the legal and practical aspects of a fund, including its relation to the EU budget, its sources of financing, and this is very important piece of text, on innovative financial instruments consistent with the European Union treaties. We have kept this promise at a very high level in Europe in the following months, and these are very good news indeed for Europe. Looking ahead, in 2021, the measures must be adapted to the evolution of the crisis and serve to pave the way for recovery. In the same terms, taking advantage of all synergies of an harmonized action. Although the prospects for vaccination are encouraging, the intensity of the second wave or third wave, its duration and the related containment measures were not foreseen, calling for preserving favorable financing conditions, which the ECB Governing Council did in December. The sovereign asset purchase programs, the so-called PEP, was reinforced in 500 billion euros, and the mechanism of liquidity provision to the banking sector was also reinforced by means of easing its availability terms. The aim was to ensure favorable conditions across all sectors of the economy, and the expression all sectors is quite important because we have been facing a strong asymmetry of the crisis as it evolves. The transmission of the monetary policy across all euro area countries is key, not only to the success of our economies, promoting cohesion and convergence, but also to the political legitimacy of the European project. The results speak for themselves so far. Portugal was able to allot 1 year debt with the lowest rate of return among all euro area countries. The interest rate differentials between Portugal and Germany have been at a minimum since 2010. The crisis today is unequal. It is a challenge for policies. Conditions for credit access should be favorable, although loans should not be encouraged without economic sustainability. The pre-crisis economic and financial conditions were favorable, certainly not comparable with the financial and sovereign debt crisis. The rules imposed by most governments to access new credit lines, often with state guarantees, and to benefit from moratoria were demanding, avoiding prolonging unsustainable firms with non-performing loans or taxes overdue. These two factors set favorable terms for what lies ahead. However, with the successive waves of the pandemic, the prolonged economic stress placed on families and firms poses a challenging environment. Private and public players must put forward the best of their efforts. In the coming months, monetary policy will continue to support all sectors of the economy and ensure that credit flows through the economy. For their part, budgetary authorities should avoid the negative impacts associated with the abrupt ending of some of the measures. Portugal has seen a strong implementation of economic and social measures. Given their impact and effectiveness, income support measures such as a simplified furlough instrument and several liquidity support measures such as moratoria and rescheduling tax and contributions payments should be maintained throughout the year, but adapted to the evolution of the economic crisis. Adaptation is the challenge that governments and other policymakers are going to face in the next few months. The pace of recovery of the economy, the asymmetry among sectors and firms, but also among households require wise exit strategies from today's policies. European policy must recognize these differences and devise policies that sustain a healthy recovery. Withdrawing benefits all at once or at the same pace for all firms and individuals will be a mistake. At this, fiscal policy has an advantage over monetary policy. Fiscal policy can target particular agents, while monetary policy is broad-based in nature, so they must complement each other. From a central banker perspective, but also in the mind of many analysts across all countries, moratoria are a major concern in the aftermath of the crisis, and the take-up for moratoria was very large in Portugal. The first thing to realize is that moratoria are not waivers. Households and firms should resume credit repayment, but gradually and effectively, allowing for a smooth return to normality. In Portugal, by September 2021, up to 11 billion repayments provided in credit plans are estimated to be postponed due to moratoria. Again, this is not debt accumulation, but rather a deferral of payment, while accommodating this moment to when activity returns to levels closer to the pre-crisis period. Indeed, the same is expected to occur with the budgetary rules in Europe and the Eurosystem's monetary policy. They all should concur to this moment. In Portugal, authorities have been following EU guidelines regarding the response to the pandemics. Firstly, measures targeted at supporting the income of households and firms have been implemented, and they are temporary in nature. Secondly, the preparation of the National Recovery and Resilience Plan has been progressing timely and comprising the social, climate, and digital dimensions. One notable feature of the last decade, which has actually started even earlier, has been the good performance of exporting firms. Firms have adapted operations, taking into consideration the drivers of export success, notably by increasing flexibility in response to orders and investing in research and development. In this context, exporters seem prepared to respond positively to the challenges posed in the post-pandemic period and support economic growth. In a context where other member states also strive for progress, the weak demography, shortages in some public capital dimensions, frictions in the functioning of labor and product markets, and the small, medium-sized and still high indebtedness of firms are structural challenges to overcome in Portugal that we cannot forget. In this context, the efficient utilization of the new groundbreaking EU financial instruments is key, taking the right balance between support and exigency towards those benefiting from it. This will surely be a continuously challenging effort for those engaged in monitoring this process. Let me sum up. We also have witnessed in Portugal an upward revision of the estimates for economic activity, of the initial estimates for economic activity, as Governor Různá just mentioned, happens also in the Czech Republic. At this moment in time, the pandemic is hitting us again very heavily. So it is the responsibility of the banking system, firms, households, the state, and European authorities to prepare for this moment. Each economic agent should act according to its specific tasks and needs. The European society as a whole should ensure that vaccination and the attainment of herd immunity are concomitant with the resumption of prior responsibilities. Science has brought us a ray of light, making the first day of the rest of the pandemic. This light is unquestionable one of hope. I would say a big hope, but it also illuminates our collective responsibility. This is what we need to do right now. As Commissioner Ferreira said in a statement, keep safe, be prepared for the recovery, prepare the recovery, and act in a very responsible way again. So thank you for your attention. I hand it to
Thank
you.
you very much, Governor, for your valuable insights. Now you can use them. I would like to benefit from the opportunity of having the former Eurogroup Group chair in the panel. This doesn't happen every day. Allow me to ask you one short follow-up question, if it is possible to answer within 1 minute. It's about the role of the euro in convergence. As a former chair of the Eurogroup, you have also hands-on experience with the single currency, and you know the euro very well from the Portuguese perspective. And as you may know, the Czech Republic has not yet decided to join the single currency. And one of the key arguments has been that the Czech Republic has not achieved a sufficient level of real convergence. Portugal adopted the euro at a much lower level of convergence in 1999. So how would you assess the role of the single currency based on the experience of Portugal, but also maybe of other countries which joined the euro recently? Is the euro, can it be seen as an additional trigger of convergence, or rather as a complication to the catching up process? Please try to be concise.
Okay, I'll try to be thank you for your question. It's a very challenging one, but I'll try to be concise. The euro area is facing a very significant challenge by means of increasing the international role of the euro. It is a long-term goal of the European Union for the euro to be our common currency for all member states of the European Union. This is something that we must take to ourselves, and it is the responsibility of each country and the European Union and the euro area to prepare their institutions to that moment. I think this is quite endogenous economically. So that's why I initially stated that we need strong and flexible institutions. And the euro proved this time to be a very, very flexible and very, very strong institution to benefit all member states. So the risks that some countries could see 10 years ago, for example, regarding the euro are today much smaller because of the evolution of the institution euro. And I think this also is some of the concerns that countries may have. So I definitely encourage the Czech authorities to continue preparing the country, urging also the euro area to evolve in order to accommodate all countries' need, and this will definitely prove to be a success in years to come. And also, never forget this, convergence is a long-term process. It is not something that we can judge over a very short time window, and all authorities need to keep that commitment over decades. It's not a matter of a couple of years. So let's work together.
Thank you. Thank you very much for your reply, for your short reply. And now let's turn immediately to the next speaker, Mr. Ricardo Mourinho Felix, who is joining us from Luxembourg. He's the Vice President of the European Investment Bank. And as the previous speakers, he has also experience from both the Central Bank and the Ministry of Finance, where he served for several years as Deputy Minister and Secretary of State. So dear Mr. Felix, the floor is yours.
Thank you very much, Pavlina. Well, dear governors, dear Deputy Minister, Mr. Ambassador, dear Director General, distinguished guests, ladies and gentlemen, thank you very much. I'm very pleased to be here today, and thanks for the invitation for this good discussion, for this panel. And I'm even more pleased because the convergence and cohesion is at the heart of the EIB. It's in fact enshrined in the statutes of the EIB that convergence and cohesion is a key part of our mandate. And I'd like to congratulate the ambassador, Luis Almeida Sampaio, for organizing this conference, and to say that I'm very happy, but I'll be much happier if we had the opportunity of meeting in person in Prague, but unfortunately, given the world we live today, it's not possible. I'll say for the third time, because the governor of Bank of Portugal said it 2 times, that convergence is in fact a long-run process. And being a long-run process, it's something very serious, because it's something that you need to decide today to take effect and impact years ahead, implying that all the policymakers need to make the appropriate efforts, the appropriate investments today in order to the next generations to grab the fruits of the disinvestment. So convergence is an investment in the proper sense of the word, not in the sense of gross fixed capital formation, but in the sense of doing something in benefit of our generation, but also in the benefit of our future generations. And this is investing in health, this is investing in employment, this is investing in digital, but also investing in education and innovation and development. And that's how at the European Investment Bank we see investment as moving our societies ahead and make the best for us, for our citizens, and for our coming generations. So in this respect, I would say that convergence process is an everyday work of every policymakers, and we need to be committed. It's a never-ending process, and we are well aware of this. Of course, that the speed of convergence changes from country to country. Portugal and Czech Republic share many features, but are quite different in some other features in the convergence process. For instance, in fact, Portugal entered at a much earlier stage. It has a steady convergence process till 2000. Then it stays at the same level of convergence. And when the financial crisis came, it dropped dramatically from 85% to 75% of EU GDP. And then it took 5 years to revert half of this decline. And that's a very important lesson. Convergence takes a lot of time to make, but it can drop very suddenly, and then you need to restart again. So this implies that the institutions in the country, the investment must be sustained. And that's something that I think it's very important at the current stage and for discussion at the European level, which is about how we see in the future cohesion and the role of investment and public investment in cohesion, the role of the fiscal rules, and how can we shelter investment during severe downturns. And in fact, it's extremely important from the investment survey, which is an annual survey that the EIB conducts. I think it's the best source for analyzing and studying investment that we have in Europe. What you can learn from this year edition of the investment survey is that most of the firms are thinking about delaying or even cutting investment going forward. And it's not about lack of funding. It's not about bottlenecks, though there exists some, and certain reforms are necessary. It's about uncertainty. And that's the key issue of this pandemic, and that's how the recovery needs to be shaped. we need to provide certainty. We need to provide steering to our economies. We need to provide a message of what's the role of the state and what can the government give as a signal or as an indication of a trend vis-a-vis what is the risks of a normal economic life. And that went very well in this crisis compared to the previous one. There was a very coordinated action of all the actors, the Commission, the ECB, the EIB, the national governments. All of these institutions act in coordination at the early stages of the crisis, and this avoided, I would say, a much bigger catastrophe in Europe. That make a big difference. Of course, that this changed the way we look at the policy these days. Liquidity was a problem at the very early stages of the crisis. ECB put the liquidity on the market, and governments, EIB, have joined provided the risking products such that banks pass this liquidity to the corporate sector. That was very important at the early stages of the crisis. Now we are facing a new challenge, which is after 1 year of this crisis, losses materialized. And now what we face is the solvency issue. And I think it's key that there is the same coordination to address the solvency issue. And in this respect, I think that the ERRF is extremely important. EIB, through InvestEU, is putting on the terrain also measures that provide de-risking products to banks, either through guarantees, but also through the EIF, the European Investment Fund, to the SMEs, through venture capital, through equity products and quasi-equity products that allow to robust the solvency of the firms, such that the access to liquidity is made in a sound manner, and that will not lead to an over-indebtedness situation that will drag down the firms down the line. But the response to COVID also implied flexibility. There was flexibility in the management of the previous multi-annual financial framework. There was flexibility on the EIB side in terms of redirecting our funding, in allowing a flexible change in the projects that were approved, in terms of relaxing the so-called Kumu rule, implying that EIB finances more than 50% of the projects, and it can even go to 100% in some cases, not only for COVID directly related spending like health, hospitals, all the supplies, but also those projects that are indirectly linked to the COVID crisis, and that allow firms to relieve funds and institutions to relieve funds to finance the economy. But we have also relaxed state aid rules, and that's other very important part, because relaxing state aid rules is quite helpful in terms of allowing the state to provide aid to the economy, but it makes a lot of difference in terms of cohesion or in terms of creating possibilities of divergence, because countries start in very different positions. And of course, by relaxing state aid rules, the countries that are in much better financial position can extend much larger amounts of state aid to their economies than those that are in a not so good position. And this may jeopardize the internal market. So I think it's key that in the RRF and in the next generation EU, we can provide the funds that are necessary in order for the countries that are not so in not such a good position, that are not so affluent, may also cope and take advantage of stated rules to preserve the best and the viable and the firms of their economies, preserve employment and create value. So on the next steps and how to relaunch the economy, I think that it's key to support investment and to keep investment floating, but also to support solvency of firms. And in this respect, I think that from a cohesion perspective, it's extremely important for the objectives that we have in Europe, the climate transition, the digital transition, that we have into operation a just transition. And to this just transition, we'll have the just transition mechanism. At the EIB, it's under my oversight, the just transition mechanism, and we are already working on that, and we are more than happy to work with the countries, in particular the countries of cohesion, in order to allow the regions that might have been more hit by the crisis, but also that will need to move from a fossil fuel world into a green energy stance. We are prepared to provide both advisory and funding in order to facilitate and to allow for this transition to be the one that leaves no one behind. We are aware that a just transition is more than a just climate and a digital transition. It's a social transition, it's a change in infrastructures, it's a change in the social model. It's providing, it's creating human capital and transforming the human capital that exists for a world in which the fossil fuels lose its relevance. So that's very important. Maybe to conclude, and what have we done at the EIB. So over the last multi-annual financial framework, we have extended 400 billions of funding to EU countries. Out of this 400 billions, 1/3 is cohesion, is for cohesion. We extend funds for cohesion through funds that are structural program funds that allow countries to finance their co-financing part in the structural funds, but also through framework loans and loans to banks that then can extend this to SMEs. In fact, in late 2020, 2 Czech banks have benefited from 2 MPLs. We have a quite important relation with Czech Republic, with Portugal, with a very large share of cohesion. In the case of these countries, the share of cohesion goes to 80% of the loans that and the funding that we extend. So we are committed to keep on this track. We are committed to foster investment in Europe and to foster a climate transition that is fair and that allows for all the citizens of Europe to move to a better, greener, and Europe and a more developed Europe. Thank you very much.
Thank you very much, Mr. Felix. Thank you for this overview on how the EIB helps to overcome the economic difficulties caused by the pandemics. It's clear that the EIB is getting more than ever involved in the common EU efforts, and be it under the just transition mechanism or the climate transition. Thank you also for the overview and the bridge to the issue of next generation EU and the new multi-annual financial framework. I have information from the studio that His Excellency Ambassador Sampaio wants to ask a question, so the floor is yours.
Thank you very much. A brief question, thanking, of course, all the speakers so far for the very comprehensive overview. One of the main subject matters that I discuss time and again with my Czech interlocutors here in Prague, almost on a daily basis, unfortunately now by video almost all of the time. But one of the main questions regarding the financial instruments that were adopted in the context of the new generation Europe and also in the context of the approval of the new MFF, the question of solidarity and what that entails. Let me try to be a little bit more precise. When we talk about solidarity, and it was really the name of the game, and very well so in the face of the pandemic and its consequences, solidarity is always a two-way street. And solidarity always comes attached to conditionality and also in the long run many Czechs, not only from the financial and economic circles, but also the wider public and even younger generations, what the approval of the new, innovative, very solidary financial instruments will entail in terms of fiscal and the budget sovereign prerogatives of the different European Union member nations. Are we going in the long run in the context of deepening the economic, monetary and economic union to face a situation where our parliaments will lose their grip, their prerogatives over our fiscal, national fiscal and budget policies? And it is also an important debate, intellectually speaking, because the Czech Republic is not yet part of the common currency. We don't know if it will be part one day, but it is also this question about the union of transfers and what that represents in terms of politics and even in terms of constitution. It is a question that I get more often than not when I discuss this solidarity perspective that even now, as we see, even coming very closely to forms of mutualization of the debt. So I would like anyone, the two governors, the vice president, the deputy minister, director general, to be so kind and try to comment on what I just said. Thank you very much.
So who would like to respond to this question? There isn't any volunteer, as I can see.
I can volunteer. Okay.
Okay, thank you very much.
No problem. Well, Mr. Ambassador, thank you very much for the question you've put. I think it's a quite complex one. It's about our common future, in a sense. Well, first, starting by the financial instruments. The financial instruments that we have on the next generation, and in the MFF, in fact, are instruments that tend to leverage the funds that were put forward, not only in the next MFF, but also by the next generation. And of course, that creating financial instruments is always a way of managing in a more, let's say, efficient manner the funds that exist. And just to give an example, as we have grants, we can use grants to give transfers or subsidies, or we can use them to cover risk, and by leveraging it, creating a bigger amount of liquidity and protect from risk. So in a sense, this creates this new debt that is being issued by the Commission, creates some solidarity. One thing that I never liked, but maybe it's because the discussions I had in the last 5 years, it's that say that solidarity comes always attached with conditionality. I would say that solidarity comes always attached with responsibility. That's the two-way that I see. I think that this responsibility is in Europe enforced by the rules that we have, and of course that these rules that we have impose in a sense conditions, but it's key that the countries understand that these conditions are not for sake of punishment, are for sake of good management of fiscal policies. And that's the reason why we should always and at every time consider to revise these rules. And that's the reason why I alluded to investment, because I think it's extremely inefficient to impose a rule that leads countries as a first, as soon as they enter into recession, to cut on investment. And we should shelter investment, because our good policy would say the opposite. You say that you should keep investment, because it's the investment that generates the future growth that will allow you to keep the living standards of your citizens and to render that sustainable. In terms of the fiscal sovereignty, and I think that in the current juncture, of course, that there are rules. These rules limit the sovereignty of countries, maybe in deciding on how big are the deficits and debt that they can incur. But I would say that the discussion about the transfer union, it's something that will take some time. I think that this crisis will be a very important test to this possible existence of, let's say, a fiscal union. I don't like the word transfer union because it's not about just transfers. It's about deciding jointly and commonly how we are getting to finance our future. And this is a much deeper decision than just about creating a transfer union. So I think that deepening the EMU, I would like to know what the governors think and how they see this deepening of the EMU. I would say that in terms of the Europe as a whole, it would be extremely important to have more integration on the fiscal side, but this is something that requires the support of EU citizens. This cannot be done against the will of EU citizens because otherwise it can backfire, but also to have a more integrated capital market union that allows funds to flow across Europe and the risk to be more evenly distributed, and also to have a banking union that allows all the European citizens to have their banks more protected and to be on equal foot in every country of Europe. And well, that's my kickoff. Thank you.
Thank you very much for your response. Does anybody else want to react to this question on deepening of the EMU on the fiscal side, transfer union, etc.? Well, if this is not the case, I would now pass the floor to the next speaker, who is Mrs. Lenka Dupáková, the only lady on the panel. Mrs. Dupáková is Deputy Minister of Finance, responsible for international relations and financial regulation. We are very pleased to have you here, Deputy Minister, also because we know that this meeting collides with the ECOFIN meeting. So we are looking forward to hearing your views on the issues previously discussed. Please.
Thank you a lot. Good afternoon. I would like to thank the ambassador, the Institute, and the European Commission representation for the opportunity to discuss the issue of cohesion and convergence. This process is indeed one of the primary objectives of the European integration and is particularly relevant for the catching up economies and their citizens. Let me start by thinking aloud about the impact of the new European economic landscape on cohesion and convergence. The economic development last year was marked by containment measures against the spread of the pandemic, as it was mentioned by the previous speakers. These measures have taken their toll on the economic developments across EU member states. The available comparable GDP projections for 2020 point to a slump of 7.4% GDP in the EU as a whole, while a recovery of 4.1% is forecast this year. For the Czech Republic and Portugal, the estimates a respective drop in output of 6.9% and 9.3% for last year, and growth of 3.1% and 5.4% for this year. Looking at the detailed regional breakdown, a far sizable contraction is forecast in the southern countries than in the EU core and in the Nordic states. This illustrates that the depth of the recession in 2020 and the speed of the recovery in 2021-22 is expected to vary widely across member states. This reflects not only differences in the severity of the pandemic, but also differences in economic structures, imbalances, and domestic policy responses. Most countries that have been hit the hardest have already shown a relative large stock of public and private debt. Some of the net debtor countries hit by the pandemic also show a relatively high share of tourism revenues, such as Cyprus, Greece, Spain, and also Portugal. In a nutshell, the pandemic shock appears to exacerbate existing imbalances and hamper the convergence process within the EU. I would also like to focus on how will Portugal and Czech Republic face the economic and financial challenges stemming from the crisis. A key instrument for enhancing convergence among member states is an effective internal market. Strengthening the integrity of the single market is needed both at the EU and at the national levels. At the union level, it is the cohesion policy which has contributed crucially to the functioning of the internal market and the use of its potential. It is the cohesion policy which allows even less developed countries and regions to reap the benefits of the internal market. Therefore, I strongly believe that the cohesion policy should remain one of the key EU budget elements beyond 2020. At the national level, the implementation of growth-friendly and sustainable policies is crucial for the stability, variability, and development of the internal market. It was the necessary structural reforms and the EU funds which have contributed to the economic growth and convergence to the Czech Republic. Going forward, these policies need to stay in the forefront and should be geared towards addressing long-term challenges that both the Czech Republic and Portugal are facing. With respect to the Czech Republic, these challenges are namely lagging productivity growth, shifting to higher value-added activities, green transition, and high carbon dependency, and of course the issue of population aging. Let me also spend a couple of moments on the intervention of the EU level with particular focus on EU budget instruments. The Recovery and Resilience Facility and other financial support instruments put in place at the Euro area and the EU level, including Just Transition Fund, React EU, and higher flexibility in the use of remaining EU funds, are all worthwhile initiatives. The Czech Republic and Portugal have been rather successful in implementing EU cohesion policy funds. A total of almost 22 billion euros was allocated to the Czech Republic for the period 2014 to 2020, which is roughly the same amount like was allocated for the Portugal. Regarding the future, in the period 2021-27, Portugal will receive even 3 billion euros more from cohesion policy funds than in the present period, meaning a total of 24 billion euros. This amount includes additional resources for the React EU initiative from the Next Generation EU framework. On the contrary, given the increase of its relative economic prosperity, the Czech Republic will benefit from cohesion policy resources reduced by almost 1 billion euros, amounting to approximately 21 billion euros. The reduction in the Czech cohesion policy envelope is primarily related to the fact that the Czech Republic and most of its regions have achieved tangible real convergence over the last decade. While in 2010, the Czech GNI per capita stood at 78% of EU average, in 2019, it reached the level of 87% of EU average. In addition to the cohesion policy, both countries will implement resources from the new recovery and resilient facility, as it was mentioned many times today, and it should support investments and structural reforms essential to a lasting recovery from the crisis. Portugal could receive up to 14 billion euros from this facility, depending, of course, on the real effects of the crisis, and the Czech Republic about half of this amount. The significant difference in both allocation is due to the low unemployment rate in the Czech Republic. Given the large amount of funds allocated to the MFF, to the recovery plan for the coming period, it will be crucial for both countries that these funds are properly targeted to support convergence and resilience of their economies. The large-scale financial support is tailored to help member states mitigate the effects of the economic recession. Also, thanks to the fact that part of these resources, the Next Generation EU package, will not be repaid until 2027, the recovery plan will bring net benefits from the EU budget to less developed member states, such as the Czech Republic and Portugal. That is why the government of the Czech Republic works hard on the timely adoption of necessary documents so that the implementation of European resources can begin as soon as possible. At today's ECOFIN Council, our Minister of Finance presented our priorities for our national recovery plan. Let me conclude by expressing my strongest hope that the effective policy response, both at the national and the EU level, will help all EU countries to swiftly overcome the crisis with limited impact on the potential output and upward convergence. Thank you.
Thank you very much, Deputy Minister. It's very good to hear your optimism that the current crisis and the upcoming reinforced EU funding, although lower than in Portugal, will be an opportunity for the Czech economy to undergo a deep structural change and to move to a modern economy. We are behind the clock, but Still, I would like to ask you a very short question about a specific feature which distinguishes Portugal and the Czech Republic. And this is a certain reluctance of the Czech Republic to benefit from loan-based measures of various EU support program. The Czech Republic is one of the few countries which have not joined the EIB European Guarantee Fund for the SMEs. The Czech Republic also hesitates to use the SURE program, which aims at supporting short-term employment measures. Also, we have signals that the Czech Republic does not intend to benefit from the opportunity to use loans under the Recovery and Resilience Facility. So can you please comment, what is the state of play, the state of thinking here in the Czech Republic? What is behind this reluctance, whether it's related to the fact that the Czech Republic has more ample fiscal capacity, lower debt, or whether it's related to less experience with loans and risk finances in the Czech Republic, or whether there are other factors.
Thank you for this question, because I think it's quite actual and quite relevant one. Firstly, I would like to say that the Czech Republic very appreciate an immediate EU response to the crisis. The European institutions suggested several instruments, namely a temporary instrument to promote the mitigation of unemployment. It was the SURE instrument, EIB Guarantee Fund, as you explicitly mentioned, and also the credit line from the European Stability Mechanism, because we are not part of the Eurozone, we are also not part of this ESM. As for the SURE instrument, loans to the member states, of course, should reduce the effects of unemployment. So it was quite a relevant instrument. And the requirement, the condition for this was the guarantee by the EU budget. So the government of the Czech Republic decided to provide the guarantee in June to support this instrument as all other EU states. As to the EIB Guarantee Fund, I think that the possible involvement of the Czech Republic is still under discussion. Nevertheless, the guarantee of the Czech Republic would amount to about 6.1 billion, which was one of the reasons why the Czech Republic has not yet joined. And of course, there was a guaranteed loss, which was amounting in the case of the Czech Republic at about 1.5 billion euros. And it is the reason which still is this instrument is a discuss, and we were a little bit cautious about. But thank you for this question.
Thank you very much. Thank you very much for your answer. And now I will turn immediately to the last speaker of this panel, Mr. José Carlos de Azevedo Pereira, who is the Director General of the Planning, Strategy, Evaluation and International Relations Office of the Ministry of Finance of Portugal. So we will conclude this panel again with a Portuguese perspective. So the floor is yours, Mr. Pereira.
Thank you. First of all, I would like to thank Ambassador Almeida Sampaio and, of course, the representation of the EU in Prague and all distinguished guests for this invitation to participate in this cycle of conference whose title could not be more emblematic, Europe After Pandemic. And it is a great pleasure that I participate, especially among these distinguished guests like each other. I would like to just, I know that I have too much time, but I will pass through and to be not repetitive to what our latest one said about the Portuguese and the Czech Republic, I will just briefly pointed everything. I was not to do it, but after what they said, I changed somehow the question, because I have to to start saying these two things. Europe has always lived in a situation of political tension. If we think all the different empires that have been created through this history since classical time, the Greek Empire, the Roman Empire, and everything. So we are always facing creating great coalitions of countries, then disappearing that. So we have to be very sure what we want to not be on that situation. Second one is the existence of economic crisis is a natural phenomenon in the economy, but pandemic crisis that is although less frequent are cyclical too. So we are not a different situation that somehow our ancestors lived 100 years ago in the Spanish flu and something like that was very big one. But today is different and we have to do it. But in that sense, the starting point of it is important because I want to introduce a different thing, the paradigm of structural power that I think fits well the current formulation of the national political economic, which probably you maybe know, and is important for me to state. In this theory, idealized for Susan Strange, presents power as based on 4 pillars: security, that provision of security by some of two others, the most basic of human needs is in basic. Production can be defined as sum of all arrangement determining what is produced by whom for whom. It is people at work and the wealth they produce by working. The financial pillar is the power to create credit, the monetary system, the denomination of money, the question of debt, the exchange rate, the interest rates at all. It's one of the most powerful pillars, as we know. Then the last one, but not least, knowledge determines what knowledge is discovered, how it is stored, and who communicates, and by what means to whom and what terms. The reasons for presenting this paradigm to you is that I believe that this way we can better observe the current reality in the light of this framework. In this context, the European Union was built or taught with aim of establishing peace after 2 devastating wars as Europe. We are therefore facing the pillar of security, but in order to be successful, the founding fathers of Europe taught that in order to be successful, Europe had to guarantee prosperity, for that it had to share its resources in order to produce and trade, the pillar of production. The other 2 pillars have been the glue for the prosperity of the European economy. Thus, the financial part has been extremely debated lately. In this sense, the advance of the banking and capital union are very important, and all investment made in Rady are essential. What we all realize is that progress in the European convergence process cannot be disconnected from the reality experienced by European citizens. European governance structure only moves forward with a common will. It will like that we all main moments of the European impulse. We know that if all citizens are not aware and not in the same mood, the European will not function. However, Brexit is a sign that European construction is not immovable, but it's the answer of 2 people, main expectation, and cease to make sense. Moreover, those expectations remain in that initial focus, security and prosperity. So for that, we need to stake on those 4 pillars. Only with this way, we increase employment, income, and reduce inequality and make convergence possible. The issue of security has also another importance when faced with demographic pressures, the issue of refugees and commercial tensions. In this sense, of course, we came to pandemic. Pandemic is, of course, a security issue and was treated worldwide that way. And that there was a clear trade-off between the economy and wealth, with health issue overlapping naturally. The sanitary crisis we are experiencing is not unique. Not was the first, as I said before, Above, cyclically, the world economy has been experiencing severe health crisis with dire consequences. As I said, this again focuses on one of the pillars I mentioned above, security. And when people's safety is at stake, the entire structure breaks down, which is why the first task is to solve the health issue. Hence, the first impulse was to close, to protect when it came from outside. When that did not work, vaccines were thought about. Millions of euros were invested, as we can see, financial. And we are the other three pillars that work to solve the fourth pillar: financial, knowledge by all pharmaceuticals, and production. Produce all the vaccines in the very faster way. It is important to note that there has been a major evolution. At the beginning of the pandemic, it seems that Europe was divided, and the first countries to feel the effect were ostracized. When the European Commission took the pulse and all the countries took apart, as we said before, ECB and IEB and the other institutions, and to decide to invest in effective vaccination and the recovery and resilience program, Europe came together and the European spirit was felt again. This is a sign of hope, as we have noticed that Europe can work together and they have the same goals. Nevertheless, there are risks and challenges. The end of multilateralism, and we have to be very worried about this. With increasing distrust of the globalization, the role of the state, and even what is going to happen to work with China and all about that. And we need to strengthen security and defense policy even more, so without the United Kingdom among us. Productive potential failing due the technological and quantitative transfer to countries with lower production costs combined with strong aging population, as was mentioned before. Resurgence of nationalist and populist movements, leading to unilateral response not favorable to either democracy or to European spirit. Increase of unemployment, poverty, and inequality in and between countries. There's the importance about that. As it was said before, the exit in the pandemic crisis in different situations that can lead us to rules of being raised ahead of time, creating problems for the weakest countries. The two last things, the question of changing of the function of working, like telework, the digitalization, and final, but the most important thing that we're facing now from the youngest generation, the climate change. This is far away the one of the bigger risks that we have faced too. Saying about the question of Czech Republic and Portugal, we have to just, I will show this kind of graph from 1990 to now. And it was asked before why Czech Republic didn't enter in the EU. And it seems that from that, Czech Republic converged faster than Portugal. In fact, I can say in the opposite. It was being said that Portugal, in fact, have from 2000 to now not a huge growth, but we have faced three crises: the balance of payments crisis, the financial crisis, then the last one, the debt sovereignty crisis, and we didn't fall mostly more than this because we were in the euro area, and that is important thing. Of course, that means that in the last 20 years our growth was not very fast. But in fact, as our former Minister of Finance and the Secretary of State said, it was awful that in the last 5 years our growth speed out, and the unemployment decreased, the balance of payments recovery, our imbalance were much of them solved, and in one crisis it dropped, and we have to restart it again. And as all my distinguished guests that talk later, we have to face it and to pick up again. And for Portugal, for Czech and for Europe, this crisis could be an opportunity to reinvent itself and make the European model of growth again benchmark for the world. But that will be only possible if Europe is committed to convergence, reducing inequalities, and the prosperity of its citizens. Thank you very much. And I will speed up because I'm completely out of time. Just to...
Thank you very much. This was the perspective of Mr. José Carlos Azevedo Pereira. Thank you for your interesting comparisons of the convergence process in Portugal and Czechia. Unfortunately, as also you mentioned, we have completely run out of the time scheduled for this first panel. So I will take the liberty to wrap up the panel and I will try to summarize the panel in a few takeaways. So the main points were that the convergence story of Portugal and the Czech Republic is a story of European solidarity. Both countries have benefited from the convergence machine of the single market, supported by strong investment impulses from the EU budget. Convergence is also a very long-term process, we have heard. While the catching up process has been more linear for Czechia, Portugal has seen a certain deceleration in convergence in the past 20 years. The speakers have also agreed that we are now experiencing a crisis of historical proportions, which consists of a symmetric shock with very asymmetric effects on the European economies and individual sectors. And we have also heard that the pandemics will most probably exacerbate the existing imbalances and that can hamper convergence within the internal market going forward. But on the positive tone, we can observe that every crisis leads to progress in European integration. And while the crisis of 2008 to 11 was a powerful trigger for reinforcing the architecture of the Eurozone, the current crisis seems to be again an impulse for reform activities at the EU level. Another point, Europe is now much better equipped than 10 years ago in terms of institutions and policies to tackle the crisis. This also gives rise to optimism. In the most recent developments have shown that there is appetite to address the current crisis with a common action at the EU level, also including a significant expansion of the EU budget and also the novelty in issuing the EU debt, common EU debt. Yes, so these are the main points that I have made from the panel. Thank you very much. I would like to thank to all the speakers that they have devoted their time, their precious time. I apologize for being a very lenient moderator of the conference, but the panel was consisted of really distinguished guests, and I didn't want to deprive the audience of the possibility to hear their views. So thank you very much, and I will now pass the floor back to His Excellency Ambassador Sampaio for his concluding remarks for this panel.
So I would like to thank European Commissioner Elisa Ferreira for her important initial address, and very especially the participants of this panel for the remarkable discussion they engaged in, as well as the broad audience for its commitment, and also, of course, to congratulate Pavlina Jakova for an excellent moderation of the debate and a very accurate summing up. Let me tell you that our intention is to publish at the end of the Portuguese presidency the main takeaways from our conferences, and for that purpose, the wrap-ups that our moderators deliver at the end of each panel will be a major contribution. I sincerely believe that this panel was the best possible start for our cycle of conferences, and I am pretty sure that the great number of followers that we have today share my sentiment. Thank you very much again. Now, taking leave of the participants in panel 1 and wishing them a COVID-free 2021, let me turn immediately, without any pause or technical break, to the second panel of our conference. My warm welcome to the participants in the second part of this first conference, part of the cycle of conferences organized by the Portuguese Embassy in Prague and its partner organizations in the context of the Portuguese presidency of the Council of the European Union. Our guest speakers, whom I thank in advance for their participation, are the guarantee of a very successful conference, and our knowledgeable and experienced moderator, Helena Horska, will introduce them in a moment. Let me also profusely thank our partner organizations, the European Commission, through its representation in the Czech Republic, the prestigious Institute for Politics and Society, and the European Investment Bank. Without them, this conference would not have been possible. This second panel, and indeed this first conference, aims to contribute to the discussion about the similarities and the differences of the Portuguese and Czech European integration processes in order to promote a better understanding of the impact of the current crisis on the economic and financial models of convergence of both countries. And now, with no further ado, it is my pleasure to hand the floor to Helena Horska for her to keep the ball rolling. Helena, the floor is yours.
Oh, hello, good afternoon, everybody. Many thanks for inviting me and having me here. This time I enter the role of moderator of this very nice and I think very communicated discussion. It's my pleasure to welcome all participants and entire audience. I welcome all the distinguished speakers who are coming not only from Czech Republic, my colleagues here, but also from Portugal. In alphabetical order, there are Vasil Hudak, Josef Kotrba, Ricardo Ferreira Reis, Manuel Rodriguez, and Michal Skořepa. My ambition is to stimulate the discussion mainly about the challenges stemming from the coronavirus shock, export-led recovery of Czech, but also the Portuguese economy, convergence and cohesion, if both enter a new stage, so-called convergence 2.0, but also the cooperation and coordination may be the best way to cope with the current shock and post-shock situation in our economies. And in my view, my favorite one, the quick win or win-win strategies that both of our countries may share here. So please let me say something about the organization. I ask, because of the restricted time, each speaker to speak maximum 5 to 6 minutes. Unfortunately, I need to be very strict because time is running. And I hope that all of you will follow this rule, because we would like to have a time for discussion and questions. Please, Mr. Rodriguez, the floor is yours, but maybe I will introduce you personally. Mr. Rodriguez is a lecturer of finance management at King's Business School, and I consider him as an expert on public and business finance. So, Mr. Rodriguez, the floor is yours, and please keep the 7 minutes limit. Thank you.
Thank you so much. It's an enormous pleasure to be with you here, Elena Orska. And I also would like to use this opportunity to thank all the organizations, especially our ambassador, Almeida Sampaio, for the initiative together with EIB, with the prestigious also Czech Institute, and all the keynote speakers that are joining me in this panel. Michael Sorepa, Ricardo Ferreira Reis, Monica Zalkova, Boholos Kiev, and Vasil Hudav, together also with the former panel where we had our governors and the vice president of EIB, and also José Carlos Azevedo Pereira, together with our Czech counterparts. So today I would use this, there is someone with the microphone on. Okay, perfect. So we'll use this moment to do a quick reflection, a very quick reflection about the convergence process between Portugal and the Czech Republic towards the European Union in the last 20 years, 15 years in the case of Portugal, and also look at the challenges that we have ahead. I would just ask Elena if we are seeing my screen that I just shared. Elena, are you able to see my screen?
Yeah, I can see.
Okay, you can see the slides, right? Okay, perfect. So you can see my slides. Excellent. So we will start the first slide by looking precisely about. It's important to look at the last few years and to understand how quick was the convergence of Portugal and the Czech Republic since they joined the European Union. Portugal joined the European Union in 1986, and from 1986 till 2000, it had a growth that surpassed and was more than twice the average of the other members within the European Union. And the Czech Republic the same since 2004. And we can see in this graph the importance and the big advantage and of the European project in allowing different countries to accelerate their growth, and as this has been extremely important. Second aspect that I would like to look, and we can also learn from the Czech Republic. I think the mouse, let me see if I can just jump to the next slide. Just a second. Okay, perfect. Is that something we can learn from the Czech Republic has been about the trade's role in the development of the country. Exports have played a dramatic role particularly since the Czech Republic joined the European Union. And we can see that since then, the weight of exports more than triples and now represents almost 80% of the GDP in the case of the Czech Republic. So also, the European project is an enormous opportunity for an increased role of external demand. Now, if you look, and this is the case of the Czech Republic, is an enormous successful case from the perspective of looking at external demand. And we're going back to this point at the end of my presentation, where I'd like to open the window of how should be the world, how can be the world after COVID, and how can we re-energize the growth after the very strong economic and sanitary crisis we are facing. Looking at Portugal, and we are now looking to the weight of exports of goods. We are not including services. In case of Portugal, Portugal exports today goods and services that amount to 43% of the GDP. Here it's just the exports of goods. And this is an important role. Why? Because Portugal was able to overcome the last financial crisis by increasing the weight of exports of goods and services from 29% of the GDP to 43%. The exports of services in the case of Portugal is much more important than in the case of the Czech Republic, where services amount for more than 10% of the GDP. Now, the first message, and we'll look into the convergence of our two countries and understanding the differences and the key messages. And again, we can see that since the Czech Republic in the convergence process joined the European Union, this has been an enormous success in the terms of trade balance. There has been a trade balance of 8% of the GDP in 2019, which means that the Czech Republic is probably the country, together with Germany, with the highest trade surplus. So the highest external surplus in the European Union. And this is an extremely important element in guaranteeing that the countries are generating, are increasing their net external position. In the case of Portugal, this is a space where we need to progress. If you look to the external account of goods, then we can see a large deficit, where we bring services in that will be balanced and cancelled. So the fourth message I would like to convey is about unemployment, and unemployment is also a result of how the economies are doing. And we can see also that Czech Republic has a level of unemployment, which we call below 4%. It's usually below the natural level of unemployment. So there is almost no unemployment in the Czech Republic as of 2020, before COVID arose. And in case of Portugal, also we had a dramatic decrease of unemployment since 2013. Now, let's look to the challenge we have ahead, and then let's look back to the solutions that we can point to try to tackle the large crisis we are facing. Now, very quick, because we are short in time, we can see that anything we can do today depends on the sanitary crisis. We cannot do an economic projection without understanding that we are at the world peak of new cases of COVID every day. We never had so many cases on a daily, new cases on a daily basis that we are having now worldwide, and this is compromising the growth prospects of 2021. Now, this means that this crisis has no comparison with the financial crisis of 2009 and 2010, because the impact, according to the World Economic Outlook, is more than twice, and this was as expected by April, but now we can say for most countries is more than 3 times, not the case of Portugal, not the case of Ireland, not the case of other countries, but for the core European countries, it's more than 3 times the impact they suffered in the last financial crisis. Now, we can see that the growth prospects were dramatically affected last year. We expect a recovery this year, but of course, because the first semester is still going to be a semester of recession, it's difficult that even if we grow a lot in the second one, once the sanitary crisis is controlled, then we are not expecting a full year of growth. And those projections are from the European Commission as of November 2020. Now, the message is, and now we jump into the public deficit and public accounts and the role they perform. We can understand that, yes, we had the highest deficits on our memory across Europe last year. This year, we'll still have 2021 and expecting a large deficit. And we can see that probably across the European Union, most countries will add up 20 percentage points of public indebtedness during the next, from 2010 to 2021.
Sorry for interrupting you. Can we go directly to your suggestion regarding the restart of your and also the Czech economy? Your idea, what is the most important things for restarting our economies? Thank you.
Perfect. So the first message is, thank you so much, Elena, for raising this point. So the first message is we will need to guarantee that we have a strong support from the European Central Bank. The European Central Bank is acting energetically, but we know that the amount of quantitative easing as measured as percentage of the European Union GDP is still lagging behind the dimension of the plan of the quantitative easing of, for example, the Federal Reserve or even the Bank of England. So the first message is we will need monetary support until the last country of the unit is back to recovery. The second message that we need to convey has to do with the lessons that we learned in the last financial crisis. We cannot compromise at any cost our public finances. We know the cost of compromising public finances. We know that by compromising public finances, we risked in the last financial crisis of losing the sovereignty of several countries, and that did happen. And this means that we need to be looking at ways to support economies without compromising public finances, without running extremely high public deficits. And that means that the attention needs to be drawn into the European Central Bank action and not necessarily in terms of stabilization on the governments and their action in terms of financial support. Finally, the message is, how are we going to generate growth following COVID? Now, growth, we need to look at the external demand. But how are we going to look at the external demand? Now, surprisingly, and I'm finishing now, COVID-19, it reversed the wave of global protectionism that we were seeing in 2017, 2018, and 2019. Already at an expected moment, the European Union was able to set an agreement with the United Kingdom to have a trade agreement. The European Union is now at the point of setting an agreement, a trade agreement with China, an investment agreement that represents an internationalization platform for European companies. China and more 15 countries just celebrated a month and a half ago the last trade agreement in the world, and those countries include Japan and New Zealand. And finally, we are expecting the new administration in the US to look more multilateral and more open to global trade. So global trade can look and be again an engine of boosting growth once COVID is stabilized, and that should be by the second semester of this year. And this is an opportunity for us to use, and that's where the Czech Republic is a good example. External demand has an engine to propel our economies, to generate more jobs and more employment and more prosperity to the whole European Union. And this is an important element. So I think we are short in time. We might get back to this on the discussion. Thank you, Elena, and for the extra time.
So thank you very much for very interesting comments and points. I hope that we will can come to some of your comments later on. May I have one very simple question? Because you know that Asian economies also based, or the recovery from the beginning of 90s were driven by export. Don't you see the risk for Portuguese economy to rely on export-driven recovery? Because if you are based on export, you are focused on external demand, and you don't have the external demand under control. So is the problem, is the risk in it? Please, very short answer. Thank you.
Elena, this is an extremely important question and point of reflection. I don't have a crystal ball, but I think together we can get in this panel, we can use the panel to discuss, and I think, and I'm sure Professor Ricardo Reis that will follow, will also help to shed some light on this front. But let me tell you, I think let's look at the Czech Republic or Germany as an extremely good example. Trade and an external demand, and for example, exports represent almost 80% of the GDP. In the case of Portugal, unfortunately, we have a high level of debt. So we will need to be driven, our economy needs to be driven more by the external demand. It's not that we do not rely too much. Actually, the weight of exports is 2/3 of the weight of exports on the GDP when we compare to the Czech Republic. So there is space, and in the case of Portugal, there is space. When I'm looking to the external demand, I'm also looking to replacing imports. I give you an example, Elena. In the case of Portugal, about half of what we consume in agriculture and fisheries is imported. Half. This is a number that leaves us really uncomfortable. So when I'm looking to the impact of the impact in terms of the GDP, I'm looking not only on increasing exports, but also on rebalancing some sectors where we have a chronic deficit of imports, and they are critical sectors such as the primary sector, where we almost import about half of what we consume. So this is a reflection, but also we need to look to the European Union as a single area, has a single economic area. So when I sell and buy within the European Union, I'm within my area, I'm within an area where we have a free circulation of goods, of services and capital. So we need to be stronger as European Union. We need to use, the largest market of consumers worldwide to make our companies more competitive and to, target not only the population that we have in our countries, 10 million, more or less the same between Czech Republic and Portugal, but tapping a market of more than 460 million of consumers that are looking forward to welcome our products. Thank you, Elena, for your question.
So thank you very much. I hope you will stay with us and please follow our another speakers, because then we will react and discuss the idea of each other. Please let me give the floor to Vasil Hudak, the Vice Chair and Vice Chairman of Globsec in Bratislava. I hope that Vasil is with us and he is able to speak.
I'm here. I'm with you.
Thank you, Vasil. The floor is yours.
I think I'm here at this conference rather in my position as member of the Czech National Investment Council of the National Development Fund. But anyway, great to be here, great to be with you, and huge appreciation to Ambassador Sampaio, to the Portuguese presidency of the EU, to the EU delegation in Prague, as well as Czech Institute for Politics and Society for organizing this event. Now, I'll be brief, and I was very happy to see some former colleagues from the EIB. I used to work as Vice President of the European Investment Bank and also as Minister of Economy of Slovakia, which was also quite successful in its process of convergence with Czech Republic. So try to put together these experiences from public and private sector, as I was also working for JP Morgan and Citibank and Credit Suisse in the past. So I think what was already mentioned clearly demonstrates that both Czech Republic and Portugal have had very successful trajectory of convergence, moving on the agenda of cohesion in the last 20 years. We also see that in both cases the slowdown in the convergence process happened during the crisis time. This was the financial crisis, 2008-10. I expect the same slowdown now during the COVID crisis. So basically, we need to combine both convergence and resilience issues when we talk about long-term sustainable cohesion roadmap. Now, I'll go very briefly into what I see are the two main threats for the cohesion and the convergence process. The first one is what I call, what I would define as middle income trap for both countries, actually, for both Portugal and Czech Republic. And the second one is the current structure of financing of economic recovery, which is mostly driven by subsidies and by the EU grants, which I believe could become distortive for the markets. Let me go very briefly into both areas. The first one, in terms of the middle income trap, I think history shows that the conversion path for at least for the Czech Republic was very much driven by FDI, especially into the auto sector, which was very successful. Now I think we came to the end of this old economic model of development, and the big question is, what is the new economic model of development, which would be at the core of convergence? I think it is quite clear that the new economic model has to be driven by innovation. The basically strategy of the European Commission focusing on green and digital transformation is a good way how to move such innovation into the economy. I think what needs to happen could be summarized in 5 areas of priority investment needs. One is, or the first one would be investment into skills and jobs. For example, in the Czech Republic, it is estimated that around 40 to 70% of jobs are at risk because of the process of automation in the next decade. The second area is massive support to R&D and innovation, and especially to the commercialization of research and innovation. Third one is SME support, especially in the form of SME digitalization, because currently most of the digitalization is focused on large enterprises, but SME sector is lagging behind. The fourth one would be support for sustainable transport and energy, and especially energy transformation from the fossil fuel driven to non-fossil is critical. And here, such instruments as Just Transition Fund are very, very important. And last but not least is transformation of the public sector, where public sector has to become much more pro-innovation part of the mechanism, and institutionally has to support this process. On the second point about the current way of financing economic development or recovery, I am concerned, and this is maybe because I come from the banking background, I am concerned about the fact that current recovery is very much driven by public funds, especially based on subsidies and grants, so non-repayable instruments. We can see it in the massive amounts of money coming through the multi-annual financial framework, through the recovery and resilience fund, through Just Transition Fund, etc. These are billions and billions of euros which are coming, and they, on one hand, obviously are very important for jump-starting the economy after the COVID crisis, but they can also become a negative element for market economy if they become too much prevalent. And I think one of the issues is how do we utilize this public money to leverage private resources? This is actually one of the issues that which we are facing at the National Development Fund, which was recently created in the Czech Republic. This is the fund which is supposed to invest primarily into PPP, public-private partnership projects. But what we see in the Czech Republic is de facto non-existence of PPP projects, except for D4, which was recently launched, but this is one and only, and we don't see too many of those. So the question is, how do we leverage private resources utilizing the public funds, and how do we make sure that market economy is not subdued or damaged by this inflow of grants? So I would finish here and rather leave the space for the others. Thank you very much.
So Vasil, thank you very much for keeping our very tough time schedule. May I have one question regarding the new economic model? Because definitely I agree with you that our economies need the new economic model to find out. Do you believe that also Portugal need to found and define the new economic model, and in which areas do you think they need to be more active and should support? So which areas they should support, in your view?
Yeah. Well, frankly, I'm not a big expert on Portugal, but I think there are many similarities between Portugal and Czech Republic in terms of the size of economy, population, etc. Both are very much export-driven economies. As Manuel mentioned in his previous presentation, Czech Republic was more successful in utilizing the export-driven parts of economy, also in bringing more foreign direct investment into the economy, especially to the car production sector. I think at the end of the day, it is about the ability of the country, of the society to produce higher labor productivity, and the fact that this productivity has to go over the labor cost and create competitive products. So I think it is very much, as I mentioned, about innovation, about the ability of the governments and private sector to produce such innovative products and transfer innovation into commercial sector. I think these are challenges for both Czech Republic and Portugal, because these are relatively small economies. They can compete only if they are competitive, and competitiveness is not driven by innovation. So I would say that would be my view.
Okay. Thank you so much. And I know that your time schedule is very tough and full of events. So I would be happy, and all of us would be happy, if you can stay once you can. And I will postpone the floor to Mr. Ricardo Ferreira Reis. And I hope he will also react on the news that he already heard here. And Mr. Reis is a director of Center of Applied Studies in Católica Lisbon School of Business and Economics. And he is expert on finance, informational economics, corporate governance. So, Mr. Ricardo, the floor is yours.
Very good afternoon. I think dobro dan is the appropriate greeting in Czech. It's a real pleasure to be with you today. And I want to greet the ambassador and the embassy for the effort on promoting this dialogue, which I think is actually part of my conclusion, which is that we need to extend dialogues between Europe to promote the recovery. I'll be extremely brief in my presentation. So I'll speak for about 3 to 4 minutes, which will allow us to compensate and catch up a few minutes. As I will talk, I think you can see my screen at this point, I will talk primarily of car racing and the alphabet, which is things that people know very well. The first thing is that I don't know if you follow Formula One, but basically we are in the state where the pace car gets in and the race kind of halts and we all catch up. So we are going through an immediate and artificial convergence process because we all stopped more or less at the same time. This allows us to get a fresh restart for everyone, which is a fresh restart that is more or less alike. And the speed at the restart, if you follow Formula One, you know this, the speed at restart is crucial. This is not about the pole position, it's where we are when the race starts again. Now, I followed carefully the presentations of the first panel, and Governor Brusnak said something that was quite important and struck a chord here, which is this, and Governor Centeno also emphasized this. This is a very asymmetric crisis. It's also one that will be asymmetric in its restart as well. In particular, as Governor Brusnak pointed out, particular industries are being more affected than other industries. So countries that specialize in certain industries will also be more affected than others within the European Union. So a key notion here is that the solidarity doesn't need to come or doesn't have to come between countries. It has to come between industries. And so when we talk about solidarity, we more emphasize the fact that the country, as Portugal, that depends more on tourism will be harder hit and needs more solidarity, not because it's Portugal, but because its tourism is being more affected than other industries. So it's time for Europe to consider itself as a space that has a diversified economy and not as a space of diversified economies, right? So the whole block needs to be looked in a different perspective, especially because the recovery will not be or the restart, the race we're gonna race after the restart, after the pace car leaves, is going to be a different race. As you mentioned, or I think you mentioned and Manuel mentioned as well, China hardly stopped during this race. The US will have a different driver on the different pilot driving the race car, so it will be following a different approach. The US is on a different track at this point, so we're facing a few changes here. Let me briefly go over how we look at what happened and what the recovery will be. The recovery will take various shapes. People thought that this crisis was going to be a V-shaped crisis. It ended up being a W-shaped crisis. In the case of Portugal, we'll see what the consequence of this is. And because it's asymmetric, we will have countries that will go up and countries that will go down, or if you want, industries that will go up and industries that will not go up at the same pace. So the recovery will more go in a divergent fashion, such as a K. This is what happened to Portugal in the last couple of quarters. These are the OECD numbers. The 2019 numbers would lead us to think that the economy was going to go steadily up. But with the COVID crisis, we had a strong dip in the second quarter, with a very strong recovery in the third, and again another dip in the fourth quarter, and a projected recovery afterwards. So here's the W, very problematic W, not because of the two valleys, but because the recovery is going to be very slow, right? Reasons for the dip and the recovery, primarily, let me see if I can move forward, would be tourism. I would go over the data, but we're out of time. What I wanted to show is that at some point, the OECD traced two scenarios in June, an optimistic one based on a V curve, a pessimistic one based on a W curve. You'll see that Portugal is faring better than either scenario, including better than the more optimistic scenario. But the problem is the recovery, and the recovery will lead us to a situation below the worst possible scenario. In comparison, the Czech Republic, which is here on the left, you can see that you are also faring better than the more optimistic scenario. But you will get within the scenarios after the recovery, your W is not as crippled as our W in the recovery. The Eurozone is here on the right. You will see that the Eurozone will actually fare better than the best scenario after a while. So you'll see that the adjustment of the scenarios leads us to conclude that Portugal is in trouble, but it's a long-run trouble. And it goes back to the question you were asking, Elena, which is, how can Portugal reinvent itself to survive? And my answer is, don't look at Portugal as a specific economy within Europe, but as a part of the European economies that will suffer because of its industry more than the rest. I completely agree with the previous speakers that thinking more of innovation, thinking more of other areas, creating a more diverse economy is the way to go. Hopefully, the speed of our recovery will be such that we will be able to catch this first wave, this first open run that we will have after we all catch up. Well, I'm sorry, I was brief, but in the interest of time, I decided to abbreviate significantly what I had to say.
Thank you very much for keeping the time. I appreciate it. And my question, it's about the divergence instead of convergence, because you mentioned that there is the risk of divergence, not only inside the country, inside the economy, between the different sectors, but also in like between or among the countries.
Yes.
So do you believe that we are able, with the new economic model based on new technology, on innovations, it may help to cope with the divergence or the risk of divergence, or do you think we need to do more?
I think it's inevitable that we need to do more. I think it's inevitable that we need to get stronger economies. I think you will experience, this is what I think, it's not what I know, unfortunately. I mean, I know very little, I think a lot, sorry. What I think will happen in the next couple of quarters is that the Portuguese economy will actually not do that bad because there is a accumulated demand for tourism that will fire up in the once vaccination is in place. So within the next year, you'll likely see a surge of traveling. And we need to have the infrastructures ready, the hotels, the airports, the facilities ready to accommodate this. My fear is that this boondoggle, this good news on the economy, which is very short-lived, it's something that has to do with a stock effect, not a consistent effect, with an accumulated effect that's going to be released, will disfocus us from thinking into new ways that are more structural and more targeting the long run. And this is where I fear that there are two fears I have. One is the organization, the planning to accommodate this restart of the economy. The second one is this long-run effect that we should have in preparation of a new economy, of a new mentality, of new trading blocks, of new players that will exist in the world economy. What space is there for Europe to operate in articulation? What place is there for Portugal within this Europe that will play in this fashion? If we stick to tourism, if we stick to what we are been doing, so be a nice place to visit, which we are, by the way, and you're all invited to come over. Will just be a nice place to visit, but not adding the value that is lasting in the economy. So that's the fear that I have at this point.
Okay, thank you so much. And believe me, once I can go, I will go back to Portugal to play the golf.
Yes,
thank
do
you.
that.
So the next speaker will be the Michal Skořepa, the Czech, and I would say the famous economist from Česká spořitelna. He often comments the various economic policy issues in Czech media, and he also served as the advisor of the board, Czech National Bank board member. So Michal, thank you for coming and join us, and the floor is yours. Thank you.
Thanks a lot. Good afternoon to everybody. I have some slides which I prepared, but I'm not sure whether they are visible at this moment, because I believe it's always better. Some of us take information better by ears, and some of us through eyes. So I think it's good to use both channels.
The pictures are nice.
Yes. So let's skip to the next slide, please. So I have a list of a few aspects of the Czech economy. I will focus on the Czech economy, which might be viewed at first sight as advantages of this economy. It's a quite long list, but my point will be that at least some of these aspects may in fact turn out to be weaknesses. From a different point of view, they might be an advantage at this moment in the fight against the corona crisis, but they might conceal certain weak spots, soft spots of the economy, and they raise questions, in my view, which we should not avoid just because at this moment these aspects are beneficial. Next slide, please. So the first aspect, which probably is without any dispute a good thing to have, is a high level of interest rates at the beginning of the crisis, because then the central bank, of course, has a room to reduce them sharply and thus to help the economy by easing the monetary policy. Czech situation is the blue line, where you can see we're essentially in the same situation as, for example, the Federal Reserve, unlike, for example, ECB, where the rates, as we all know, have been very, very low for a long time. So this is one aspect where things were okay for this country a year ago. Next slide, please. The second case, this is a very messy picture, but the basic idea should be clear. Czech Republic is the black line, and it shows the capital ratio, CET1 capital ratio, and it just is meant to illustrate very generally that Czech banking sector has enjoyed a fairly high CET1 capital ratio. We are certainly at least in the middle of the EU, which is the range of values you see in the picture, or probably we are in the better half. So another strong point, which probably is something that's undoubtedly a good thing to have. Next slide, please. Now we enter the terrain where things are more complicated. One is the labor market. As you can see, again, the black line is the Czech line, and you see that the Czech Republic has well enjoyed, in quote unquote, enjoyed the very lowest rate of unemployment in the whole of the EU for a few years already. But my question mark that I raise here is the possibility, and here I maybe come back to the possibility or the issue of export-led growth. The question is, to what extent the Czech Republic has been able to have an export-led growth thanks to low wages. So there is a very thin line between export-led growth, which is beneficial for the economy, and export-led growth, which is essentially based on low wages, so that the domestic population does not really enjoy that growth. But on the surface of it, GDP may grow quite fast. And by the way, Czech Republic is one of the countries in the EU where the difference between GDP and GNI, gross national income, the money that stays in the country, is the biggest in all of Europe. So we have nice labor market data, but the question is whether this is really completely just a good thing, or maybe something to hesitate to follow in the future again. Next slide, please. Let's keep this one. It illustrates another these are different numbers again, showing that Czech labor market has been extremely tight in recent years. Next slide, please. So there was, of course, some convergence, and fairly fast one actually, over the last several years. This chart shows us the convergence of Czech Republic to Germany in terms of GDP per capita. And again, I think the speed of convergence shows that we started very low, and that the process is very fast, and that the gap, also gap in wages, probably is shrinking. So the problem at the beginning with low wages probably is, of course, being solved over time. The equilibrium processes in the end do surface, but it takes some time. And I think it shows clearly, it's seen from this chart clearly, that this is something that was taking place in this country over the last several years. Next slide, please. Another seemingly good news about Czech economy is the very low level of the public debt, which of course is a nice thing to have in this time when governments are taking on more and more debt all over Europe. But behind this, there are quite a long list of things that we might consider as underinvestment of public goods, of infrastructure in this country. My favorite example of underinvestment is an unusual kind of investment, but still very important one, and that's teacher wages. In this country, if you take a look at comparison across OECD, you will see that actually Czech teachers have the lowest wages compared to university level education in all of OECD. So Czech governments were able to save a lot of money in this area, and the result, this is one of many examples of why we ended up in this nice place, but the nice position is bought. The price has been quite high, with implications, of course, for example, productivity in the future, because low level of quality in schools then has its negative implications. Next slide. This is my last slide. It shows that in the Czech Republic, the weight of tourism, which is the soft, of course, point at this moment, has been very low. But in my view, the strong point, the seeming strong point of this country, which is the high weight of industry, may turn out to be a weakness in the future, especially as we see the process of automation and the move to e-mobility, to electronic vehicles, which are much easier to produce. You need much fewer people to produce them. So probably there will be a lot of employees in industry in this country, which will have to look for a different job in the future. And one possibility is that they should enter the tourism industry, because I propose this because my belief is that actually after maybe 1 or 2 years, many things will go back to where they were previously. And I think I suspect that the role of tourism, international tourism, will come back to the previous levels. I don't really believe that there will be some kind of systemic change, long-term shift in this area. So that's why I think that actually this chart shows maybe one of the important future avenues which the Czech economy should follow. Mm-hmm. And that's it from my side.
Michal, thank you for keeping the time. My question is, you mentioned already one of the risks of export-driven recovery, because exactly as you mentioned, the Czech Republic is exporting country, but yeah, we are exporting the cheap labor costs. Do you see another risk for the export-driven recovery? Because from very, I would say, discussion in hurry, this one, we just have one clear conclusion. The export-driven recovery is one of the solutions from the current situation. So we should know all the risks that we may face. So do you see another risk of such a recovery strategy?
I can think of one more very important risk. I think you already mentioned it briefly. You said that you don't have the foreign demand under your control. Mm-hmm. And one important aspect of foreign demand is the exchange rate with which you actually trade with the rest of the world. So as long as the Czech economy has its own currency, as long as we are not in the Eurozone, obviously, export-led growth will always face the risk of fast changes in exchange rate because of some regional
but
sentiment.
In the case of Portugal, it's not the case because they have the common currency.
Exactly.
So there is the difference.
There is a difference between the two economies, absolutely.
Okay. So thank you for your answer. I don't know if Mr. Rodriguez would like to react on such discussion of the risk of export-led recovery. If not,
maybe I could add a comment. I'm sorry, I'm not Rodriguez, but I could add a comment concerning the single currency and the participation in the euro. Indeed, the instrument of exchange rate does not exist in the Portuguese economy, which has been extremely strengthful on the Portuguese exporters who have to compete in other areas like productivity and quality rather than price or devaluation. But that choice doesn't also happen in the Czech Republic. The advantage, however, of being part of the European Union is the elevated level of quality that we need to attain. So indeed, it must we must export based on quality, and that's more structural than exporting based on devaluation, which I know the Czech Republic hasn't done. I'm not saying it has. I'm just comparing not Portugal with the Czech Republic, but Portugal today with Portugal of before the euro. So that's the comparison, and that's where I'm coming from. In this case, I'm not comparing to the Czech Republic. I'm just saying that it's a good thing Portugal is in the euro, given the history of devaluation in Portugal.
Okay. Thank you very much, Mr. Rice, for commenting this. So the last but not least, we have Mr. Josef Kotrba here, the chairman of Deloitte and deputy CEO recently at Česká spořitelna, maybe a couple of years ago.
About quarter of a century.
It's almost history from my point of view, but I know him personally as a businessman supporting the diversity in companies in the Czech Republic. So many thanks for that. And Mr. Kotrba, floors is yours. And please comment what you have heard here.
Good afternoon. Thank you, Helena. There was a number of things, but I will start with your golf trip to Portugal because I'm better than you and more diverse. Because I already prepaid it before the last lockdown.
You know,
it's
I
waiting
paid
for
the
me.
spring, I paid for autumn, so I have opened.
I hope that the voucher doesn't expire before the year's end, and you're not going to Portugal. So hello Portugal, looking forward. But besides that, seriously, there was a lot of important topics kind of quickly mentioned, many of them focusing on similarities. There are also some very major differences in exports. Yes, we are even more export orientated than Portugal. In the same time, we are far more import demanding, or our exports are very import intensive. Why is it so? We are so deeply integrated primarily with German economy that many items cross the borders 3 times before they're finally packaged and sent, I don't know, to China or anywhere else. So there's a lot of cross-border movements. And of course, that makes us more vulnerable to turmoils, lockdowns in other countries, and B, clearly leaves us very little choice whether our recovery will be export driven or not. I don't think that Portugal has that much choice, but we certainly have even less so. And it's not bad, provided that Europe stays open inside Europe, and that Europe keeps its export abilities outside the continent. One thing I really like or admire about Portugal is level of export of services, and I can part of which being tourist related, but I can say as somebody working for a consultancy, we do see, for example, Portuguese as important players in export market of consulting services to Western Europe, and we are of course seeking ways how to compete with them. So it's a big credit to also probably to Portuguese educational system, because this is, unlike tourism, certainly not something which is a traditional industry in Portugal's, exporting IT consultants around the continent. And we should look for that as an example. We have one more challenge which Portugal doesn't have, and that's the coal slowdown, which is a major structural thing. I guess that Portugal is now almost coal-free. There's, if any, then very little coal produced energy, and we're still exporting a lot of steel, which produces CO2 emissions, not only because of energy consumption, but also in the very production of steel, and that can be kind of made more green, but it costs a lot of money, and that's a challenge Portugal doesn't have. So there will be probably Mr. Ferreira mentioned that we should expect that Portugal, having more tourism, will be more seeking subsidies. Well, we certainly will also seek external funding for that transformation. And I think tourism has far more ability to fix itself, as you properly said, and us being the witnesses or subjects or objects of evidence that we already are prepaid.
Yeah. I'm ready to go.
Unfortunately, not the case of energy sector. So I think that leaves us with what is our common interest in Europe, and this is to keep the engine running, to keep the exports markets enabling our recovery to growth. And that's probably the closing comment.
Oh, thank you.
Time-wise?
It was excellent.
5 minutes.
Exactly. So thank you very much. So if somebody, before my conclusion, if somebody from our audience, including audience here, can react, guys, please do just now. Nobody?
I don't want to react all the time, but I just want to confirm that I completely agree. 2 notes on what was just mentioned. You prove my point with the notion that you don't give subsidies to states because it's Portugal or Czechia. You give them because their industries suffer and struggle, and particular industries are going to suffer. And you're absolutely right. You also will find industries in any country that will struggle in this period. The second one is about the cooperation in services, and that also emphasizes the point that we need to act together. So a final note to Mr. Ambassador and to the Portuguese presidency: stimulate this dialogue within Europe. We need to cooperate more. Rather than compete in consulting, we should cooperate in consulting. Work together with Deloitte in Prague, like we do with Deloitte in Portugal. And expand and go global and compete with the Chinese consultants, with the American consultants, with all the consultants in the world. Do it as a European bloc. So I think the solution is in working more together.
Lost you for most of the speech.
Yeah, sorry, we have a very bad connection. Last 3 minutes. Please, can you sum up in 2 sentences? I'm very sorry.
No problem. Countries, industries need to be supported, not countries. So the solidarity must go to the industries that struggle. I mean, granted, some countries will have more struggling industries than others. Second point, cooperation. Let's do consulting together. Let's work together with partners. So a special salute to the embassy that organized this event, because this type of dialogue is necessary. You need to come here and play golf and talk to us. We need to go to Prague and visit the beautiful city and environment and exchange more, cooperate more. That's it. Those were my 2 sentences.
Thank you so much. Dear distinguished speakers, it was very nice and I think very productive discussion. And I'm very happy to say that we covered all my topics that I would like to cover here. Please let me sum up the key conclusions that we at least have it, or even the open question that we have it. The first one was the key challenges stemming from the coronavirus. So we have heard about the risk of divergency, the risk of the different impact of COVID shock to different sectors. And also we have heard about the risk that the economy and also some sectors will stay and maybe for longer stay dependent on subsidies, on state support. But we should also work on the new model of economic growth of the future. And this new economic model should be based on digitalization, new technology. But at the same time, Mr. Rodriguez mentioned there is the chance for export-driven recovery. But as was in discussion mentioned, we should be very worried about the quality of the export. So we should support the export-driven recovery that will be based on added value, the additional added from services. So we should increase the share of services in export. And also we have been discussion in the case of Czech Republic, the risk of the currency development, while the Portugal has would say experience or would say advance of having the common currency. Also regarding the convergence and cohesions, there is the risk of divergency, and we should work, as was mentioned by Mr. Rice, on cooperation, integration, and also the solidarity that we have been shown recently, and we should continue in it. Also, I'm very happy to say that I received the answer of the question of win-win strategies, and mainly, as was mentioned by Mr. Hudak, the new model, new economic model of the growth based on the digital, new technology, supporting the SMEs, supporting the research and development and commercialization of new ideas. Also, it was mentioned here also by Mr. Kotrba, we should also focus on energy strategy that is very important for Czech Republic. So we know at least some of our win-win strategy that can both of our economies help to recover faster and to overcome the problem of the different speed of restart of the sectors and also of our economies. And finally, I wish you all of you a very good year full of strong health. And I hope that only our economies, but also our as a person will enjoy this year of recovery. Thank you for listening. Thank you for time. Thank you all for our panelists. And I will take the floor to our Mr. Ambassador. Thank you, everybody.
Thank you.